don't know about us, I suppose I'll just explain briefly. Startup Grind is the largest entrepreneur network in the world now. Over 500 cities, 125 countries, last check. One simple kind of mission for us is to educate, inspire, and connect entrepreneurs and startups. So it's a real simple thing that we set out to do. In Bournemouth, I suppose what we're trying to do, myself and Leon and James and the rest of the team, is tap into the ecosystem that we know is already here. We know there's a nice network of entrepreneurs and startups here, and what we, I suppose, want to do is try and facilitate connecting them all together and trying to grow that, really. Before I hand over to Andrew, I just want to thank our sponsors. So Media Lounge, Silicon South, Dual Mode, Daisy and Recoded Recruitment for everything they've done. Obviously a massive thank you to Reem for joining us today. And also, last but not least, to Andrew, our compere. So I'll leave you with him.
Marcus, I'll see if I can get this. Is that working? Yes. Excellent. Thank you, Marcus. So I think we'll get straight into it. This is Reem. And Reem works at Accelerated Digital Ventures, and we're going to go through the things that we're going to cover off are how Reem got into VC in the first place. Then we'll talk a little bit about ADV and why they are different and how they're changing venture capital. And then hopefully we'll give you some nuggets around if you are thinking about investment, what you perhaps should think about doing, what you shouldn't do. And then we'll see where we get to. So at the end, what I'd like to see if everybody has a fairly clear idea about A, if they could get investment, and B, hopefully some ideas about how to have more of a chance of getting it. So, Reem, thank you very much for coming. Would you mind starting by telling us, or telling everybody, how you got involved in venture capital and your journey up to that point?
Sure. I think getting involved in VC, especially in London, is still quite nascent. So most people that get into VC don't have VC background. They didn't start out with an internship somewhere. Yeah, it's on.
It's on. That's right. Yeah.
So in that vein, I had started out just after business school. I was in business school in New York. I ended up working at a sovereign wealth fund in Abu Dhabi, in their advanced tech vertical. So I ended up doing sort of investments and asset management, but very, very deep in the tech stack, so sort of semiconductor space. And then on the other side of things, I was also on the side doing some angel investing. And then VC kind of sat very nicely in between, although I had no specific or direct experience there. The other thing that really helped me was I also had founder experience, as I'd set up my own luxury jewelry brand in fine jewelry, which is still going. But that also gave me some of that sort of founder-operator experience that I could speak to. So in that sort of consortium of previous professional activity kind of led me to venture capital.
Okay, and so let's talk a little bit about ADV. What sort of attracted you to ADV?
ADV specifically stood out to me amongst the landscape of VCs in London. We're very mission-driven, so our goal is not just to deploy capital and to make money and to return money to our investors. Our goal is to deploy capital and make money and return money to our investors and develop the UK ecosystem. That really was born out of our founders' first-hand experience as operators themselves. The majority of them are from Sheffield. If you know PlusNet and EasyNet, most of you will know the first ISP provider in the UK. Lee Strafford, our CEO, founded that company and had to sell early, essentially, because he couldn't find the right funding up in Sheffield, even though he shouldn't have. He should continue to grow the business himself. So fundamentally, what we're looking for are really big, scale-based opportunities. We believe that the UK has the potential to, produce the next Amazon, the next Facebook, but early-stage founders are perhaps not setting themselves up and thinking big enough from day one, nor is the capital there to match that kind of ambition. So that's what we're trying to bring to the table. Liquidity through what we see as a broken pipeline, as well as mentorship and spending time in various ecosystems to make sure that founders and other early-stage investors understand what a good one looks like.
So that brings in the concept of a couple of things, I think. Firstly, there's the concept of good money and bad money, and also patient capital, which I think has been talked about a lot at the moment. And so that sounds like you're very much in the patient capital arena. So could you perhaps give an idea of what that means in terms of timescales and what sort of timings you're expecting founders to stick with the company and grow the company?
So, as you do very rightly point out, we are a patient venture firm. So for us, we're looking for companies to grow over a 7 to 10 year time horizon. We're not looking at a shorter 5 to 7 year scale up and exit or scale up and flip. What we look for in the long term really is opportunities and founders that can disrupt industries or create new industries. So it's not really about taking something that already exists, sectors that already exist, and making them more efficient. It's coming up with the next new way of doing things. To really be able to come up with the next new way of doing things, it will take normally a long-term time horizon for you to get to that maturity. Again, that is why we look at that 7 year time horizon. That's why we don't have to return money to our LPs over a specific time period. It's all balance sheet money, which means we don't have to liquidate a fund at a certain point.
So could you just explain what an LP is?
Okay, so it's a limited partner. So like founders will have investors, funds also have investors. The interesting thing about ADV is our investors are large institutional investors. So we have Legal in General, we have Woodford Capital, and we also have the VBB backing us. The thing that we are doing in more detail is not just direct investment. So they invest in us, we invest in founders, but we also invest in funds. So over the long term, what we're trying to do is create liquidity at the earliest stage through partnership with strong early stage investors. Then we invest directly, sort of from seed to Series A, first money in at the moment, but over time that will go later and later as we start to strengthen those early stage positions. And then to your point, our LPs, our limited partners, would like to have access to the best performing companies in our portfolio so that they'll be able to invest at much, much later stages, so sort of Series C, D, E. Back to your earlier point about good money and bad money. That really will come down to what it is you're looking to build as a founder. Not all money is going to be the right match for you. Even a good VC that has good founder-friendly terms doesn't necessarily mean it's a good match for you. You might not need VC money. It really will depend on what your business is. So, if you're applying to a fast-growth, tech-focused VC, and you are a retail business or a franchise of restaurants, that's not going to be a match. There are other sources of funding. You should be looking at friends and family in some instances, crowdfunding if you're consumer-facing, angel investors, accelerators, sometimes venture debt is a good way forward depending on what kind of business and what kind of stage you're at. So I know we're talking about VC today, but I also want you guys to be very aware of what it is you're building and therefore making sure you're getting good match.
Yeah, absolutely. And I think that brings in nicely one of the things that we were talking about earlier when we were chatting, which is the way that VC definitions, if you like, have changed in the last few years. So I think there's often confusion about what's classed as seed investing and what's Series A and what's pre-seed. Would you give us your thoughts on almost the current state of those definitions?
Yeah, well, they move really, really fast.
That's true.
I think even in the last 2 years since I've started doing VC investment, they've kind of shifted and created new categories. But you've rightly pointed out, so as institutional money starts to go earlier and earlier and try to go after younger and younger companies, the kinds of valuations, the kinds of traction that they will be looking for become more and more mature, more and more professionalized. Therefore, founders are still going to need to raise some friends and family money, some early stage money that enables them to go from concept to a product market fit or a product that might be VC backable. But since the VCs are carting out the space and going in earlier, they're already playing at seed, Series A, so new categories are being created. The activities are the same, but the labeling has shifted down. So whereas seed might have been your very first money in and some friends and family. Now there are a few additional touch points in between. So you might have a friends and family round initially, then you might have a pre-seed, then a seed, then perhaps a seed extension, and then a Series A. Yeah.
So ADV typically start at seed stage, would you say?
So currently our sweet spot is seed to Series A, so that's kind of straddling three areas: seed extension, Series A. But again, over time, our first money in will become sort of A, B, C.
So in terms of, can we perhaps talk a little bit about what seed means from your perspective? Because I think that's one of the more recognisable terms that people have, is that they want seed money. And obviously there are terms that have come in before that we can talk about in terms of friends and family and angels and pre-seed. But what does, so for a company that comes to you looking for seed funding, what would you expect there to be in place?
So you want a strong team. That's at that stage, it's early. We're not expecting you to have product.
Reem, could you hold your mic a little bit nearer?
Yeah, sure. Is this better?
That's fine, thank you.
Okay. Sorry for the sniffling, it's like cold. But at that point, the company is still going to be young. So we're not going to have expected the founding team to have established product market fit. So we don't expect the team to understand sort of what the market is willing to pay, what the business model is that's tested and scalable. In some instances, depending on the sector, they might not even have product. They might still have a concept, or they might be developing the product. So at the earliest stages, team is going to be even more important than what it is going to be later on, because that's who we're investing in. So that's the biggest point.
So would you say that team is sort of more important than the idea?
I don't think you can replace an idea with a team, right? You need to have both. And for us, we also need to understand the market. So we're looking for scale bigs. Again, not every VC has the same investment criteria. Some might be looking for 2, 3, 4, 5x return. We're looking for 40. But therefore, when we're looking at market, we want to make sure that the team is going after a big market, such that if they are successful, there's a potential for them to have a big outcome. So team, timing, and market really aren't a replacement for one another, but whereas market is a much longer term proposition, the thing we can really hang our hat on in the earliest point is the team, and believe that they can tact.
So in terms of big markets, presumably this is one of the reasons why you're looking for that real greenfield opportunity, because that gives you the bigger market opportunity. So are you looking at are you looking for the next company that can become the $8 billion pound company?
Fundamentally, yes.
Yep.
And fundamentally, we believe that the UK ecosystem can deliver that, and has done in the past, and should be doing so in more frequency.
Okay. So just going back to the seed thing a little bit, you're not, we're talking about the seed from your perspective, you're not necessarily looking for revenue necessarily?
Most of the time companies will be pre-revenue at that point.
Yeah. Okay.
So they might have some small revenue or be pre-revenue, but probably have a working prototype that they're testing of a product.
Okay, and...
but this will vary by sector, right? So a deep tech will be different to a consumer marketplace.
Yeah, absolutely. And that leads me nicely into do you have a specific sector that you're focused on? So some people, for example, won't do B2B SaaS, they will only do marketplaces or consumer. Do you have any specialism in that way?
So no, ADV is sector agnostic. There are a couple of things we won't do. We won't do medical therapies, we won't do anything that's regulated as a bank. We will do medtech, we will do fintech. But aside from that, everything is fair game. Part of our model is to open up our pipeline to founders through the venture marketplace, which I know you've checked out, and I'm hoping you'll apply to. But the venture marketplace is basically something we've set up along the lines of being a public utility. So we're not the only investor on there. We have another 7 to 8 like-minded investors that have access to that pipeline. So going back to the point that I was making about creating scale bigs across the ecosystem, providing access to capital outside of London, this is very much in line with that. So any founder can apply online, not just to ADV, but the other investors that sit alongside us there for capital. And then, depending on each investor's sort of investment criteria, they may find a match there. For us, our big goal really are to identify the scale bigs. In order to do that, though, we don't just leverage our own ADV network, we pull in outside experts to help us challenge the opportunity. And then we'll continue to provide and add value to the founders as they grow, once they become a portfolio company.
So through the Venture Hub, which I did have a little bit look at before we started, but so is that there to make the process a little bit easier? But is it also there to give you an element of de-risking because you can join together with other VCs? I mean, are you fighting over the companies that come through, or is it very much a collaborative approach?
At this point, it's neither.
Okay.
It's people have access to the same deal flow. We ourselves are always open to co-investment because we are thinking long term, and we really do believe in collaborations and partnerships. And we also believe that, different companies will be a fit for different VCs, and there will be a natural matching that will come through that process. Yeah.
Okay, so in terms of question, what's your view on crowdfunding?
I think crowdfunding, again, know what business you're in and know where to raise money from. Crowdfunding is a very reasonable way to raise money, especially if you're a consumer business. But I would think of it more as marketing rather than something that could be a longer term solution for you. And obviously, there are some businesses that are making a sort of a run of it, and that's how they're doing their fundraising. We like to see founders that are also able to go and raise institutional money. They can have strong backers, a whole network of advisors. But crowdfunding is a very reasonable thing to do if you're trying to get your name out there and your consumer brand.
And through your, I'm not sure what the right term is, sorry, through the regional funds that you're looking at, you're also looking to partner up with angels, aren't you? Is that something you can do? I know you're not directly involved, but could you talk generally about that?
That's part of our fund of funds. So as I mentioned, as ADV, we're not just doing our own direct money into companies, we're also doing money into funds. And we're looking to partner with the earlier stage investors that are strong and maybe more hands-on, with founders that might require a little bit more attention and guidance at the earlier stages, like seed, pre-seed. We are both working with established funds and established microfunds, but we're also looking to identify strong angels that could potentially anchor their own microfunds. So in those instances, we are willing to work with angels to be a capital provider and a microfund partner.
Okay, excellent. So let's jump a little bit forward. Say I have somebody in the audience has a startup that they believe they've got a good founding team. They have a clear idea of their market. The timing's right, and they're sitting here tomorrow saying, right, I need to go and pitch Reem. What do they send you?
I can tell you what not to send me.
That's just as good. That's just as good.
I'm going to take one step back. Your business is your life, and you'll understand it super intimately. You live and breathe it, and it's your baby. On the other side of the desk, as a VC, we get approached with thousands of applications a month, sometimes a week. And therefore you have to be really thoughtful about how you cut through all of that noise and really make yourself stand out. So your narrative is super important. So I know that you know it incredibly well. Don't send me the 50-page business plan. That's going to be too much for me to digest, or any VC to digest. On the other side of things, please also don't send the one-page teaser, because we don't have the patience or the time. It's more the time to be able to go back and forth and ask for more. So be very thoughtful about how you distill those three things in a very clear and succinct way. Who are you? What's the idea? What's the big opportunity? And why are you guys the right team to deliver on that? 7 to 10 pages, 20 max, but very pithy, straight to the point, team, timing, idea, and market.
So should the purpose of that document be to very clearly outline the money that they're trying to raise, or should the point of the document be, actually all I want to do is get to meet you in person so I can actually pitch?
What do you mean about the money as we're trying to raise?
A lot of people I talk to is about, do I actually put in the pitch document that I want to raise £1 million and this is what I'm going to do with it?
Yes.
Yeah, you want that
we
in?
want to see that, yeah.
Absolutely.
We want to see an ADV is special because we are patient ventures, so we want to see the big vision. So think of us as your potential Series D investor, but we also want to understand what it is you're trying to do with the cash today to get you to that next round. So a good way to think about it is, what do I want to be in 10 years' time? And then think back in phases about what you have to evidence every time you raise to get you to that next point. And then chunk up your story in those kinds of phases. Usually it's three or four phases.
So in terms of, and I think that's a really good point. So in terms of the phase that you're looking at, and this comes back to the 80-page business plan versus the one-pager, how forward-looking would you like a startup to be? So once they get onto your train, if you like, are you looking for them to be thinking about raising money in another 18 months? Is it that timing, or is it longer, is it shorter?
The typical time between raises we see is sort of 18 to 24 months. Make sure you add in a bit of a buffer. Things never go according to plan, but that's the window.
So you're looking for them to go hell for leather for 18 to 24 months, with you giving them the money to, in effect, support that growth and then go for more money at that point.
Exactly. And the key to, or the trick to thinking about fundraising, it's not just about the 24 months. It's what am I going to do in that 24 months to de-risk my investment. So how do I show potential future investors that I can execute? So when you're thinking about your milestones, think about very discrete, as in deliverable things that you can show and evidence that you've completed. Don't really try to target ongoing things that are kind of open-ended and don't necessarily show success. So if you don't have a product yet, have product tested and by X date. Or if you have certain metrics you want to test that will demonstrate your product market fit, set those and achieve those. And then you give investors a little bit more confidence that, let's say at your A, you've demonstrated product market fit, check. We don't know if you can scale, but at least now I'm willing to give you some cash to test that next bit. But don't ask for money at the beginning to do both product and product market fit and scaling, because that's way too much risk multiplied into one check.
Okay, that makes sense. And how much time does it take to go through this process? So if I wanted to raise money, when should I start talking to you should I start 6 months in advance, a month in advance?
Never a month. Yeah, it takes a month just to get the first meeting with most VCs. And again, that's what we're trying to change with the venture marketplace. We give a response within a day, at least on the first contact. But it can take anywhere between 3 and 9 months. That's what I've seen, and that's what I've heard from a lot of founders. We are getting our own methodology up and running, but part of the aim of what we're doing is try to reduce that time so that founders can operate their business rather than be fundraisers.
And this works for both parties, doesn't it? Because if you're contacting early, one of the 6 months ago, how are you getting on hitting those milestones that you told me about 6 months ago? And a lot of people I know just chuck the plan and don't really think about what they're going to be doing for the next 6 months, because they don't realise it'll be 6 months before the VCs get there. And they say, well, where are you now, as opposed to you set the plan 6 months ago. Yeah. Is that fair?
That is incredibly fair. And if you haven't hit them, that's fine, things change, but be very clear as to why that happened, and direct and honest, and be thoughtful. I mean, also don't just put random things on a paper, actually put down your plan and what it is you're testing, and proving something to be false is as valid as proving something to be true. It helps move the business along.
But make sure those KPIs, if you like, that you're trying to hit are objective and can be measured.
Yes,
yeah.
Exactly.
So can we talk a little bit about numbers? You mentioned that you're talking to, I think you used the word thousands in a month. What sort of numbers are we talking about funding? So what sort of odds are we talking about, roughly?
I can tell you in our first year, we deployed capital and have 35 companies in our portfolio. So if you do the maths and you're talking about 1 in 1,000, 1 in a few thousand, it's a difficult process.
And I think that's quite a good ratio from what I understand as well. So let's step back again and let's talk a little bit about those 3 things that we need, if you don't mind. So and I'd like to maybe focus a little bit on the team. So one of the biggest reasons that startups fail is because the founding team aren't aligned, and the founders aren't on the same page and aren't all going in the same direction. So that comes back to your point about the team. So what makes a good team for you? What are you looking for in a founding team?
In a founding team, we want to make sure that we have basically complementary skills and complementary voices. So we usually want to make sure that there's a breadth of skills to make sure that at least given that next stage until the next raise, the skills required to deliver against those measurable deliverables, they already have on board. We don't want to see that your secret sauce is something that you're outsourcing. So if you're a tech team and you have a software focus and you've outsourced your tech, that's a very bad sign to us. We want to make sure that you have that talent in-house. We also want to make sure that the team is well incented, not just the founders, because it's not just the founders that are going to build the team. We want to make sure the whole team is incented, and it's not just a bunch of employees that are in there for the short term. So we like to see an ESOP. We like to see shares given to employees that vest over time in healthy and reasonable numbers. We're not talking about 1%. And we want to make sure that they're complementary skills.
So could we talk a little bit about that a little bit more? So you'd expect to see an employee pool, and what sort of size are you looking at there? Have you got a rough figure that you give people?
Yeah, roughly 10. Okay. And usually you'll replenish that at every raise.
Okay. And can we talk a little bit about vesting? So I think that's it's actually still quite a rare concept in the UK. I think it's very common in the US. But could you just explain what vesting is and why that's important for startups?
So vesting basically means you have rights to shares, but you don't have ownership of them on day one. As you stay with a company, over time it will vest to convert from rights to ownership. So for example, if you have 100 shares and they vest over 4 years in 25% increments, you'll get 25 shares at the end of each year, as opposed to having it all up front. And what that does is it aligns your ownership with the value you create to the business over time.
And it's a 4-year vesting period, one you normally expect to see?
Yeah, 4 years is healthy.
Okay. And what about a cliff? Do you sort of like cliffs as well, or are you not that worried about it?
Not as worried.
So cliff is basically when you don't start earning any stocks until, say, a year, so 6 months ago. And if a startup doesn't have that, is that something that you would try to impose on the startup?
Again, if it's very early, usually they haven't allocated shares because they haven't figured out who the strong team members are, and usually it is just the founding team. The thing with incenting talent, usually at this level in this way, comes when you start hiring more senior talent. And that tends to be a little bit later in the life cycle of the business. The earlier stages, as a founder, I'm sure you know, you're doing everything. So, you're wearing all that. Not too many, not too few. We've invested in sole founders. Okay. That tends to raise more questions because it's a very lonely place. It's a very difficult thing to do generally with partners, and even more difficult to do alone. Plus, it's always healthy to be able to bounce ideas off of someone else. Having said that, on the other side of things, you have 4 or 5. You don't want to have too many cooks in the kitchen.
Absolutely. So I was a solo founder. I've now found a co-founder, but have you got any advice for anybody looking for co-founders? So the reason I asked that is that unfortunately I've seen some people they've been told that they've got to go and get a co-founder. So what they do is they go and meet somebody in the pub, almost join them as co-founder, and then funnily enough, they sort of fall apart 9 months later. So have you got any...
They're surprised?
Sometimes, yeah, they are, unfortunately.
It's like getting married off of a first date. I wouldn't recommend that either.
I did that too.
How did your business do?
That's a different conversation.
You're still married, I can see the ring, so that's...
It's the same woman.
You learn, you live and you learn. Sorry, what was the question?
Advice looking for co-founders.
Yeah, be careful, because it is a marriage, so, test it out a little bit. Find reasonable ways, beyond just having conversations with the person, by engaging them on small chunks of work, then longer chunks of work, and in a similar way you would vest employee shares. Have a bit of a trial period first, so that you can feel each other out, to see if you're a fit beyond just being sort of intellectually compatible. There are the questions of, can you work together day to day? And you're only going to figure that out once you roll up your sleeves and you're doing it. So do that before you bring them on board formally, because I can imagine, I've only been married the once, but I can imagine getting out of a co-founder relationship is probably as difficult as getting a divorce.
Yeah, I would imagine so. So let's jump forward a little bit now. Oh no, we've talked a little bit about team. So one of the things that we talked about was timing. Have you got any sort of advice on timing? Is it a gut thing? Do you just sort of sense the opportunities there or not?
There is a lot of intuition. So there is a lot of intuition that goes into it, but there's also a question of, is this a sector or market where there's already a lot of noise? If there is, that's not necessarily a bad thing. It might just be that no one's cracked it yet. But then you have to be even better at, one, cutting through the noise, and then two, actually having a USP that's differentiated. Both very difficult things. So you don't want to be too late to the market, but then conversely, you also don't want to be too early. There's so many companies and ideas and opportunities that started, great ideas, but they were just a little bit ahead of their time, and there wasn't a market there for them yet. Or there wasn't the right infrastructure that would help them proliferate. So there's demand, there's a product, but let's say the network isn't available for them to roll out on. If you think about it as a parade, we make sure that you are in front of a bandwagon, not marching alongside of it. And make sure you're not marching alone. Make sure that there is a groundswell that's coming behind you.
And I think that's one of the areas that VC's changed, certainly in the UK and Europe in the past 10 years. So I think what's happened now is that, I think historically VC would have invested in improvement markets. So where you've got a solution but you're trying to make it better. Whereas I think now that sort of seems to have reduced, and now a lot of people are looking for that, the next big thing, is that fair, do you think?
I know it sounds that way because that's all that we look at, and that's what I've been talking about tonight. But again, I want you to be aware that there's a whole host of different sources of funding, and there are many funds out there that are very happy to look at the 4 to 5 to 7 year time horizon, that are happy to back ideas and founders that want to exit in 4 years, that are looking for a trade sale, that are looking for a listing. So if that is what you want to build, don't change your plans to fit the money. Go find the right money to support your plans. They're out there.
Yeah, absolutely. And how do you do that though? So there are 101 funds, VCs that purport to give money to startups. And it's quite a complicated web, isn't it, of finding out who...
Figuring out which doors to knock on. First of all, what are the doors? And then how do you knock on them? And then how do you enter them? It's incredibly relationship driven and really hard to get into. We fundamentally believe that that's broken. That shouldn't exist that way. VCs should be creating value for founders because ultimately you guys are the ones that create value for us. So we should be accessible. So again, what we've done with the venture marketplace is create a portal that gives visibility to a range of investors. So we're one of several on there. It's not proprietary to us, it's open. Obviously, if you do progress past that first contact, then all of the interaction that you have with us thereafter is just with us. But just to put your opportunity out there, you can apply to the venture marketplace. And by the way, I will tell you how to apply there. If you go to the ADV website, it's just accelerator.ventures. And then from there, you'll be able to navigate and find the venture marketplace.
And let's jump forward a little bit. So, say that we've got to a position where you believe that that's an investable idea, it's a good team, the timing's right. What's your current favoured method of giving money? Is it a check? Do you phase it?
Huge check.
Big check with lots of numbers. Do you stage it? How do you do that?
No, we have, actually our term sheets are on the website. So because we're a patient venture, because we are really looking in the long term, what we care about is creating value together. We are not predatory VCs. We want to be founder fair. So the shares we take are ordinary shares. We sit alongside the founder. So what does ordinary shares mean? If things go wrong, we will get whatever's left in the same way you get whatever's left. So we don't take preferred shares where we would get paid out first before the founders. We also believe that if we're going to back you, we believe in you. So if we vote yes in IC, then you get the check for that full phase. We're not going to stage the investment. But we will hopefully invest again at the next round, assuming that you continue to grow. So when we think about staging, because we're looking over such a long time horizon, it's more round by round.
Okay, that makes sense. And so I've got my check. It's in my bank. What do you guys help me with after that point? Are you very passive? Are you quite active? Do you take an active board seat?
No, we don't seek board seats. We usually have an NED or an observer right that we want to take. Fundamentally, we are looking to invest in founders that understand their own business. We're looking for self-directed founding teams. So we're not there to micromanage. We're not there to run your business. We are there to act as a sounding board. And we are there to sit with you, ask the right questions, and think through what those targets should be and what are the metrics or the precursors, the leading indicators that will help you know that you're on the right path to achieving those targets. Once we set those, we just let you run your business. We will check in with you monthly, periodically, more frequently if you need, to make sure that things are going according to plan and ask those higher level questions. Because you guys are going to be down, sort of operating, head down, working on the business. Sometimes you'll need a sounding board to help you get perspective, and that's the role we play. We also have an extensive network. So our ADV network is open to our founders. And then we also help you think about that fundraising strategy. So part of those milestones is what makes you investable at the next round, and the next round, and the next round after that. So helping you think about your growth.
And so what are some of the issues that you see once people get the money? Are there some common threads to the challenges that tend to arise?
Sometimes they get the money for one thing and they start thinking that they should be doing something completely different. That's not entirely a bad thing, as long as it's well thought out and the pivot is there for a reason. We would never want a founding team to stick to the plan just because it's the plan. I think sometimes founding teams, once they get the check, they might lose a little bit of steam. They get a little bit of comfort that they have cash in the bank. None of our founders, but I have seen that before.
And do you use how often is your money used for liquidity for early investors? Is it ever used to get, sorry, I was going to say get rid of, but I don't.
Our earlier stage partners to provide liquidity to them so that they can go again and do more for more founders at the earlier stage, but that's a slightly different relationship.
Okay, so I could talk about this literally all night, but I've got one more question, then we can open it up. You've been VC for a while now. Have you had any misses? Have you had people go through that you've said no to, and then like Airbnb or anybody, or anybody that you've looked back on in 3 years later and thought, oh God.
Yeah, you're talking about my anti-portfolio. Yeah, so I do, as in my life as an angel. When I was living in the UAE, it's a very nascent ecosystem out there, so there's very little VC money. There's, founders are of varying backgrounds and varying degrees of professionalism. And I had a bunch of contacts, and there's one that, what was it, 4 or 5 years ago now, was raising their friends and family round, which I was invited into. And now they're raising a Series C, that would have been a 200x return on my investment back then. So that's the one that I have a tough time sleeping at night when I think of. I wouldn't be sitting here. I'd be on a boat somewhere warm.
So, somebody must have a question. Megan.
So you've kind of talked about some of your near misses, but what would you consider as the most exciting business in your portfolio at the moment?
There's so many to pick from. That's a really tough one. It's like picking amongst children.
Then none of them are here, and we maybe won't post this bit online.
One of the ones I'm most excited about is a company called Chargify. So it's a wireless charging network. It's a fantastic founding team, and the team caliber, they've just got a new chairman, a veteran in the industry out of Silicon Valley, an amazing sales team, amazing product team. What they're doing is phones to drones. So when they're thinking about wireless charging, they're thinking about charging consumer electronics today, scooters in the future, electric vehicles, and drones after that. And they have this focus on the future, this fervor, this excitement, this ability to bring great people alongside them for the ride, both from the customer side, the partner side, and the investor side.
Any other questions? Yes, Anthony at the back.
Well, I'm just kind of interested that what happens if things go wrong? Because you hear a lot of stories about fractious relationships between investors and companies, and that seems to be exacerbated in the difficult times. So I just wondered, do you have, what happens? Do you get a lot more hands-on if you see things going a little bit awry? How do those relationships pan out?
We like to add value where we can add value. So if we see a founder that's struggling, if we see a founder that is missing the targets that we laid out together, then we like to offer support. So, we might go from what would have been a more routine check-in to being there more as a sounding board. And again, more of a strategic sounding board. We will never tell a founder what to do because it's their business, but we can advise them on what we think has worked well in the past, and we can ask the right questions.
Any others? Yes, sir.
I was going to ask, is there any sort of expectation on what founders should, forego salary for 6 months, or, sensible, existence?
Well, you still have to eat, right? So.
Yeah.
I think the way we tend to think about it is make sure that the founder isn't going into debt, can survive, but isn't so comfortable that they're not as invested in the business, right? So that'll vary by location, that'll vary by sector, right? But yeah, we expect you to get paid, but
Not all of the investment.
Exactly.
And certainly not in one go. Yes, Andrew.
Oh God, my question's just gone in my head now. Is there any, in the next 3 years, are there any types of businesses that you're looking at particularly? So if you look at all the marketing jargon that's going around at the moment, blockchain, AI, blah, 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 are you looking at any of that, or are you looking at markets of recycling?
Seek specific sectors. So we see what comes through our pipeline. Marketplaces, there are already quite a few of those. So that's an example of things that are quite saturated. There's a lot of fintech infrastructure stuff we're seeing, which is interesting. Sort of banking as a service, that kind of a platform, kind of going the layer below. Yeah.
Any others? James, come on, you normally have a question.
Yeah, okay.
Go on.
Sounds like you have many, but...
What do you think the role of an NED, or how important do you think the role of an NED is at a very early stage startup? Or is that consideration for you?
Usually early stage startups don't have NEDs, they just kind of have advisors, whether formal or informal. So it's not something on our checklist that if it's not there or there, it means anything to us. We just want to make sure that the founders are well surrounded with people that advise them well. So are they able to attract smart people to work with them more than the specific title?
Have you got a follow-up?
That was it.
You sure?
I think you had a follow-up.
Go on.
Not necessarily follow-up, but how much do you look at a business that comes to you in terms of marketing and product? Because you could have a brilliant product and there's no one in the founding team that's a good marketeer or market expertise, or vice versa, might be great at marketing but the product not quite right. So where do you put the emphasis on that balance?
A lot of it has to do with stage, right? So at the earlier stage, you want to make sure that the product guy is there because that's what you're building. If you have a great marketer and no one who understands how to build a product, then you've kind of put the cart before the horse. I'm really bad at expressions, I think that's it. But as you get later down sort of the development of the business, you're going to need to layer on top of that the expertise you need to get to that next stage. So if you don't have a marketer on board day one, in your deep tech, not the end of the world. But we do need you to recognize that and to understand that you will need to bring that on board at the right time.
You can answer.
Yeah, well, obviously you talked a little bit about it earlier, but I was just interested in terms of the earliest stage at which you would be tempted to start investing money, and is there a chance before the product's been built, and if that's the case, what level of experience would you have, and would that be different compared to, say, a younger team who's been able to develop a product and created some sort of traction? What is it? Is there anything you definitely wouldn't invest in, or kind of what does somebody have to prove before you go, actually, you seem viable?
We will generally never invest pre-product unless you're deep tech. Okay. So at least for us, for our first money in, you'll find other investors, maybe university accelerators, or earlier stage family and friends, angels, accelerators, etc., that will. But for us, that's too early. But again, the funding profile varies for different sectors. So if you're thinking about sort of consumer marketplace, product should be there, or some version, early version of a product. Same thing with sort of direct sales, B2B SaaS, that type of thing. Deep tech, yeah, that we can go in pre-product then, and we have done. If you look at our portfolio online, there are a few deep tech companies in there.
So how much rigor do you actually put as an investment arm into the technology itself? How much do you get stuck into the tech and understand it before you qualify an investment?
We want to know what we're investing in. It's how we do that I think is interesting. So we do our own internal review as ADV. So it's a 3-stage process. The first stage is the venture marketplace that we've done a lot of talking about. The second stage is a deeper dive review. And that happens both with an ADV review internally as well as the external challenge that I was talking about. So we cover off on the technical diligence between those two. The external challenge, what we do is we aim to bring three to five unbiased challengers that will come in and are deep industry experts or sector experts that have knowledge and expertise that we don't have in-house. And you can actually add value to the founders and potentially develop a longer-term relationship. So in some cases, these guys have ended up being, or girls, NEDs to the companies down the road. But they help us with the diligence.
Can we just, actually there's a good follow-on there if that's okay. Yeah. What other due diligence are you looking to do pre-investment?
Usually it's around market, have they thought through it correctly, product, looking at how are things working out. And then we want to look at the financials. What assumptions have they built in? Have they thought through it deeply or not? And then the cap table. And then, are you a criminal or not?
Any other questions? No? Excellent. Right, I'd just like to say thank you very much, Reem. And
thanks for having me. suggest, I know that we've spoken a lot about the venture marketplace. If you go to our website, you'll be able to find links to the venture marketplace. Also, feel free to add me on LinkedIn, and I can also direct you through that.
We can share all the links in the email afterwards. Yeah.
Great. So what I'll do is I'll send you guys sort of a nice little summary of
Perfect.
what everything is, and you can forward that. Thanks, guys.
Thank you.
Thank you.